So, gold pulled back hard. And if you have been anywhere near the financial channels, you already heard the celebration. The tone changes the instant the metal drops. Suddenly, the anchors who ignored gold for years have all the time in the world to tell you the run is over, the bubble popped, the smart people are getting out. And I want you to notice something about that timing, because it is not an accident. The loudest voices show up exactly when you are most likely to be scared, and the scared retiree is the most profitable customer the trading desks have. If you are holding gold right now, or you have been thinking about it, and this drop has you second guessing the whole idea, I need you to slow down for the next few minutes, because a pullback is not the story. A pullback is the noise that hides the story. The real story does not even begin until the panic is over, and almost nobody is going to walk you through what happens next, because the part that matters happens quietly, after the cameras have moved on. By the time we are done here, you will understand why the crash is the setup, not the ending. Here is the one thing I want you to hold on to before we go any deeper, and it costs you nothing to remember. In a real panic, everything that people call safe gets sold at the same time, all at once, because frightened money does not sell what it wants to sell, it sells what it can sell. And when that wave finally passes, one asset behaves differently on the way out than all the others. It does not just bounce, it separates. That separation, that quiet parting of the ways after the storm, is the entire lesson. And it has happened before, in plain sight, and the people who understood it were positioned long before it became obvious. Let me take you back to a moment that almost nobody talks about anymore. And I think that is a shame, because it explains this exact situation better than anything happening today. Go back to the late 1990s. For a couple of years, the whole world had been convinced that a certain kind of money was safe. Money had poured into emerging markets, into what everyone agreed were the smart trades, the sophisticated trades. The people running them were not amateurs. They were the most credentialed minds in the business, running enormous piles of borrowed money, and the models all said the risk was under control. Then, in the summer, Russia did something the models said would not happen. It defaulted on its own debt and let its currency collapse. And what followed was not contained to Russia. It rolled outward like a shockwave. This was already sitting on top of the Asian crisis, where one currency after another had cracked the year before, from Thailand outward, each one falling into the next like a row of tiles. And here is the part I want you to feel, because your retirement lives or dies on this exact mechanism. When the panic hit, it did not stay in the risky corner where it started. It jumped the fence. It reached into the assets everyone believed were rock solid, and it repriced them in days, not months. Why does that happen? Why does the safe stuff get hit right alongside the junk? Because of leverage and because of fear, working together. When a big fund is losing badly on its risky bets, it gets a call. Put up more money right now, or we sell you out. And to raise that cash, it cannot sell the broken thing because there is no buyer for the broken thing. So it sells the good thing. It sells whatever still has a bid. That is why, in the teeth of a crisis, the quality assets get dumped first, not because anything is wrong with them, but precisely because nothing is wrong with them, which means somebody will actually buy them. The strength of an asset becomes the reason it gets sold in a panic. Sit with that, because it is the least intuitive truth in all of finance, and understanding it is the difference between panicking at the bottom and standing still. Now, watch what happened next in the late 90s, because this is the whole point. After the forced selling burned itself out, after the leveraged players had been margined into the ground and the broken trades were cleared away, the assets did not all recover the same way. The stuff that had been safe only because a model said so, the stuff that was really just borrowed money wearing a nice suit, a lot of it never came back the way people expected. But the genuinely safe things, the things that were nobody else's promise, they steadied first and then went their own way. The dust settled, and what was actually safe separated from what had only been pretending. That is not a fury. That is what a panic does. It is a sorting machine. It looks like destruction while it is happening, and it is really just the market discovering the difference between something that is solid and something that was only leveraged to look solid. And this is where gold sits in the whole picture, and why this current drop is not what the financial media is telling you it is. Gold gets sold in a panic too. Of course it does. When the fear is at its worst and everyone is scrambling for cash, gold slips for a stretch, And every headline uses that as proof it has failed as a haven. But it is not failing. It is doing the one thing that makes it a haven. It is the liquid asset in a room full of assets nobody can sell. So it is the one people can reach for to raise cash. It gets sold because it works. And then, once the forced selling is spent, gold does not just recover. It separates from the wreckage and goes its own way, while the leveraged paper that only looked safe stays down on the floor. The people who see the drop and call it the end are looking at the setup and mistaking it for the finish. So let me name what is really going on here, because you are not imagining it. There are people who make an enormous amount of money on your fear, and they are not shy about it. When you sell into a shakeout, somebody is on the other side of that trade, buying what you are handing over at the exact moment you feel worst about owning it. The trading desks do not make their money on calm. They make it on churn, on you flinching, on the retiree at the kitchen table who did everything right and now feels like a fool for holding. That feeling, that specific feeling of standing in a falling market and doubting yourself, is not a coincidence. It is the product. It is what the noise is designed to manufacture, because a frightened seller is the desk's favorite kind of seller. And this is the moment I want to talk to you directly, retiree to retiree, because this is the first real fork in the road. If you are sitting on $100,000 or more in a 401k or an IRA, and you are watching this drop, wondering how to protect what you spent 40 years building, there is something happening at the very top of the financial world that they are not putting in front of you. The central banks, the biggest and best informed buyers of gold on the planet, have been buying at a pace we have not seen in generations. For 3 straight years, they have added more than 1,000 tons a year, roughly double what they were buying the decade before. They are not day trading the dip. They are accumulating quietly through every wiggle. And here is what almost nobody tells the ordinary saver. There is a completely legal, IRS-sanctioned way for you to do the same thing they are doing inside the retirement account you already have, without triggering taxes or penalties. It is called a self-directed precious metals IRA, and it lets you move a portion of your savings into physical gold and silver that you actually own. This is not some insider club. If you have $100,000 or more in any retirement account, this is available to you. My team put together a free guide that walks through exactly how it works. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com and we will get it into your hands. No cost and no obligation. Now, let me pull you back into the analysis, because the reason central banks are behaving this way ties directly into why this drop is a setup and not a top. Something changed in the plumbing of the whole system, and it changed the reason people hold gold. Go back a few years to when a major country had its foreign currency reserves frozen almost overnight. I am not going to wade into the politics of it. I only want you to see what every central bank on earth learned that day. They learned that the reserves you hold as somebody else's promise, sitting in somebody else's system, can be switched off by a decision you do not control. But gold sitting in your own vault is nobody's promise. It cannot be frozen from a keyboard on the other side of the world. And the moment that lesson landed, the buying accelerated, and it has not stopped. Here is how big that shift really is, and this is one of those facts that should be leading every broadcast, and instead barely gets a mention. Gold has now passed the euro to become the second largest reserve asset held by central banks anywhere in the world, behind only the US dollar. Think about what that means. For the first time since the old gold-backed system was abandoned, the metal has climbed back to the number 2 seat at the table of global money, and it did it quietly, purchase by purchase, while the financial press was busy telling small savers that gold was a relic. The insiders were voting with hundreds of tons, while the crowd was being told to look the other way. And it gets more interesting, because gold has been breaking one of the oldest rules in the book. For decades, the reliable relationship was simple. When real interest rates went up, gold went down, because gold pays you nothing, and higher rates make everything that does pay you more attractive by comparison. That rule held for a generation, and in recent years, it just stopped working. Gold has climbed, even while real yields stayed high, even with a Federal Reserve that has been anything but generous. When an asset stops obeying the rule it obeyed for 30 years, that is a signal that a new and more powerful buyer has taken over the pricing. And that buyer is exactly who we just talked about. The old inverse relationship broke because central bank and physical demand became the thing setting the price, not the traders betting on interest rates. But here's the part one most want you to take with you, the middle of this whole thing, and it is the part almost nobody gets to. Everything I just described, the reserve shift, the broken rule, the record buying, none of it moves in a straight line. It moves in exactly the pattern we are living through right now. It surges, and then it shakes people out, and then it surges again. The shakeouts are not evidence against the trend, they are how the trend travels. Remember what happened after a mere hint years back that the Fed might slow its bond buying. Not a rate hike, just a hint. And gold fell about 28% that year on nothing but a suggestion. Nothing fundamental had changed about the metal. The story was intact, but the paper price got taken to the woodshed anyway, and every person who sold into that fear missed everything that came after. That is the mechanism you have to understand about how these things get priced, and it is where the paper rules meet the real metal. The price you see flashing on the screen is not really the price of holding a bar of gold in your hand. It is the price of a paper contract, traded with leverage, that can be pushed around violently in the short run by people who never intend to take delivery of a single ounce. And the rules on that paper can change on you. We have watched exchanges raise the cost of holding a position over and over, and every time they do, the leveraged speculators get flushed out. The price drops sharply, and it has nothing to do with whether the underlying thing is scarce or valuable. It only has to do with who can afford to keep their bet on. Nothing about the metal changed, only the paper rules did. And that is precisely why what you own matters as much as whether you own it, a point I will come back to before we finish. So step back and look at where we actually are, and hold the title question in your mind, because I promised I would resolve it. Gold crashed. That part is true. But look at what surrounds the crash. The central banks are still buying. The reserve shift is real, and it is historic. The old rule that used to cap gold has broken. And the crash itself, the very thing being sold to you as the end of the story, is the exact behavior gold shows right before the safe asset separates from the leveraged bets and goes its own way. In the late 90s, the panic sorted the real from the pretend. Every time the forced selling ends, the leveraged paper stays down, and the real metal walks off on its own. The pattern does not change. The names on the assets change, but the pattern is as old as fear itself. Now, I owe you some honesty, because anyone who tells you this without the honesty is selling you something. I cannot promise you a price, and I cannot promise you a date. Gold can drop further from here before it does anything else. The volatility is real, and if you buy expecting a straight line up, you are going to get shaken out just like everyone else. This is a case built on history and on structure, not a guarantee, and it is not personal financial advice for your specific situation. What I can tell you is how a thoughtful person handles it. Own the metal, not a paper promise, so that when the paper games get played, you are standing on something real. Size your position so that a sharp drop can never force you to sell, because the whole game the desks play depends on forcing your hand. And do not, whatever you do, sell into the shakeout, because selling into the shakeout is handing your seat to the people who are buying it from you. And this brings me to the thing I have been building toward, the part one saved for last on purpose. Here is what the historical pattern really tells you about where you stand right now. The people who moved before the late 90s panic sorted things out. They did not get a phone call. The central banks buying at a record pace today did not wait for permission, and they are not waiting now. The smart money already sees what the crash is. It sees the setup. But the mainstream has not caught on. The pension funds, the financial anchors, the neighbor who tells you gold is a rock you cannot eat, they are still looking at the drop and calling it the end. And that gap, that space between what the informed money already knows and what the crowd has not yet figured out, is the only place a regular person ever gets to act early. By the time it is obvious to everyone, by the time gold leads every broadcast and every advisor finally recommends it, the easy part of the move will already be behind you. Nobody sends you an invitation to be early. The invitation is the fact that it does not feel obvious yet. Which is exactly why I want to make you an offer, and why the timing of it matters. For those of you who have stayed with me all the way to the end here, and who have $100,000 or more in a retirement account, my team holds a free one-on-one educational web conference. It is not a sales pitch, and there is no obligation. It is a chance to sit down with someone who does this all day and walk through how a precious metals IRA would actually work for your specific situation, what it would cost, how the physical metal is stored, and whether it even makes sense for you. Just mention that you watched this all the way through. If you are watching on your TV, scan the QR code on your screen right now. If you are on your phone or your computer, go to jeffreedguide.com and book your time. And here is the honest reason to do it now, not later. The best moment to make a calm, clear-eyed decision is precisely when nothing feels like an emergency, when the price is drifting and the crowd is bored and you have room to think. That window is open right now. It always slams shut the moment everyone agrees, and by then, the calm decision has become a panicked one. So let me bring this all the way back to where we started and answer the question in the title as plainly as I can. Gold crashed, yes. And if you let the people who profit from your fear tell you what that means, you will believe the story is over. But the crash is not the story. The crash is the sorting machine running, the same machine that ran in the late 90s and separated what was truly safe from what only looked safe once the leverage was stripped away. The real story does not start until the panic is spent and the dust settles, and the genuinely safe asset stops falling with everything else and quietly begins to go its own way. That is the moment that matters, and it comes after the crash, not instead of it. You are not late. You are early. And being early never feels like anything at all. It just feels like a quiet afternoon while the noise tells you to be afraid. Do not sell into that noise. Understand what you are looking at. The real story starts now.